Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Solvency Ratios Explained, a simple guide to assessing financial health. Ever wondered how to measure a company's ability to pay its long-term debts? That's where solvency ratios come in. These simple yet powerful tools give insight into a company's financial stability and long-term health. In this video, we'll explain what solvency ratios are, why they matter, and how they help both investors and businesses make informed decisions. By the end, you'll have a clear understanding of how to use them to assess financial strength with confidence. What are solvency ratios? Solvency ratios are financial metrics used to evaluate a company's ability to meet its long-term obligations. In simple terms, they measure how well a business can sustain operations while paying off debts over time. These ratios are essential for assessing financial stability and identifying potential risks. For investors, lenders, and management, solvency ratios provide a clear picture of whether a company is built on solid financial ground or teetering on the edge of default. Importance of solvency ratios. Why should you care about solvency ratios? Because they speak volumes about a company's financial health. Whether you're an investor betting on a business's future, a creditor ensuring timely repayment, or a business leader making strategic decisions, these ratios are your go-to benchmarks for long-term viability. Here's why they matter. Investors want to see stability. Solvency ratios help gauge whether a company can survive economic downturns or unexpected challenges. Creditors analyze these ratios before granting loans. They assess the likelihood of getting paid back, with interest, over time. Management teams rely on these metrics to plan for growth and avoid taking on unsustainable debt levels. A solid solvency ratio indicates that a business is financially healthy and capable of weathering tough times. On the flip side, weak solvency ratios suggest potential red flags, like excessive debt or insufficient earnings, which could lead to long-term financial trouble. How solvency ratios differ from liquidity ratios. It's easy to confuse solvency ratios and liquidity ratios since both deal with a company's financial obligations. But they measure two very different things. Solvency ratios focus on the long term. They measure a company's ability to pay debts over several years. Think of it as a marathon. Can the company sustain its pace for the long haul? Liquidity ratios, on the other hand, deal with the short term. They measure whether a company can cover immediate expenses and obligations, like rent or payroll, with its current assets. In this case, it's more like a sprint. For example, the debt-to-equity ratio, a solvency ratio, looks at how much of a company's operations are funded by debt versus owner equity. Meanwhile, the current ratio, a liquidity ratio, reveals if the company can meet obligations over the next 12 months. Both are important, but they answer different questions. Solvency ratios ask, can this company endure years of financial pressure? Liquidity ratios ask, can this company pay its bills today or next week? Understanding the distinction ensures you're looking at the right numbers for your specific needs. Key solvency ratios explained. Solvency ratios are a window into a company's long-term financial strength. These metrics tell you if a business can handle its debt and survive the test of time. In this section, we'll break down the key solvency ratios, what they mean, and how they're calculated. Whether you're an investor, manager, or creditor, mastering these ratios can help you make smarter financial decisions. Debt-to-equity ratio. The debt-to-equity ratio compares a company's total debt to its shareholders' equity. It's one of the most straightforward ways to measure how dependent a business is on borrowed funds versus its own resources. To calculate it, use this formula. Debt-to-equity ratio equals total liabilities, shareholders' equity. For example, if a company has $500,000 in liabilities and $1 million in equity, its ratio would be 0.5. This means for every dollar of equity, the company has 50 cents of debt. Why does it matter? A lower ratio typically signals financial stability, while a higher ratio could mean the business is relying too much on debt. It's especially important for creditors, who use this ratio to assess a company's risk level before issuing loans. Debt ratio. The debt ratio measures what percentage of a company's assets are financed by debt. It's a handy tool for gauging financial leverage. Use this formula to calculate it. Debt ratio equals total liabilities, total assets. Say a business has $300,000 in liabilities and $600,000 in assets. Its debt ratio would be 0.5 or 50%. This indicates half of the company's assets are funded by borrowing. What can you learn from this? A lower debt ratio suggests more ownership of assets, while a higher ratio raises concerns about over-leverage. A rule of thumb: anything over 60-70% might indicate financial vulnerability, depending on the industry. Equity ratio. The equity ratio flips the debt ratio around, showing what portion of a company's assets is financed by shareholders' equity. The formula is simple. Equity ratio equals shareholders' equity, total assets. For instance, if a company's equity is $400,000 and its total assets equal $800,000, the equity ratio would be 0.5 or 50%. This means half of the company's assets are funded by investors. Why is this important for shareholders? A higher equity ratio often signals a financially stable company with lower reliance on debt. It can also mean less risk in times of economic uncertainty. Interest coverage ratio. The interest coverage ratio reveals how well a company can pay the interest expense on its outstanding debt using its earnings. Here's the formula. Interest coverage ratio equals earnings before interest and taxes, EBIT, interest expense. For example, if a company's EBIT is $200,000 and its interest expense is $50,000, its ratio would be 4. This means the company earns enough to cover its interest payments 4 times over. Why does it matter? A higher interest coverage ratio shows the company is in good shape to meet its debt obligations. On the other hand, a ratio below 1 is a big red flag. It means the company doesn't earn enough to cover its interest expenses. Cash flow to debt ratio. The cash flow to debt ratio measures how effectively a company's operating cash flow can cover its total debt. This ratio offers real insight into solvency because cash flow drives a company's ability to pay down debt over time. Use this formula. Cash flow to debt ratio equals operating cash flow, total debt. If a business generates $150,000 in operating cash flow and owes $300,000 in total debt, the ratio would be 0.5. In other words, it generates enough cash flow to pay off 50% of its total debt annually. Why is this critical? Unlike profits, cash flow can't be manipulated as easily. A low ratio suggests the company might struggle to meet debt obligations, while a high ratio signals financial security and efficient cash management. These solvency ratios are more than just numbers. They're a way to quantify how financially robust, or fragile, a company really is. By understanding and using these tools, you can avoid potential pitfalls and make informed decisions, whether you're evaluating investments, approving loans, or running your own business. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.